The market does not care, not about tariffs, not about the Fed, and not about earnings. The market does have to care, though, about one thing. It's what moves the market. It's the imbalance of buyers and sellers. And over the last few sessions, it's quite clear who has the edge out there. So welcome back to the Trade Brigade Midweek Show, where we'll take a look through all of the data points to evaluate that edge, and then we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY daily time frame chart, and all we want to do here is reevaluate our base case. Remember that we had set a low, we had set the highest high in the trend count, and the Monday deep seek gap down from now 2 weeks ago was the first place for a potential higher low in the trend count. Now, obviously, the tariff gap down this Monday puts that low in jeopardy. So all we want to do here is ask ourselves the questions: did stronger sellers express any sort of attempt to move the market lower aggressively? The first thing that would have been the most bearish on Monday's open would have been an opening drive to the downside that found acceptance in the CPI gap and closed the gap here. Did that take place? Obviously, the answer is no. The next most bearish thing that I could have envisioned would have been a partial gap fill reversal underneath the Monday low of the deep seek move. That would have set a lower high on the daily time frame chart, something that would have looked like this perhaps. Maybe we dribble around, and then eventually it's a test of the CPI gap. Did that take place? The answer is no. The next bearish thing that could have taken place is a full gap fill reversal underneath the Friday low of last week. So some sort of rally, a lower high gets set, some sort of move back down underneath 595.85, and then of course we're still seeking that CPI gap close. Did this take place? The answer is no. And the reason we're using the Friday low and really just the 599.65 as the key level where a lower high could have been set for stronger sellers to express that edge is because that would have left all of the traders who participated after the deep seek move as overhead supply. If these traders were going to panic out of their positions, and if stronger sellers were going to express that edge in the market, ideally, sellers would have kept price in the worst case scenario underneath 599.65. And clearly, as of today's Wednesday close, that is not the case. So on the daily time frame chart, I still think that the agenda here is looking for an uptrend to build, and to do that going forward, we need to see sustained holds over 599.65. It would just be out of this world if we opened on another gap down for next Monday. You know the playbook at this point, but at this, going forward, holds of 599.65 look pretty darn good. If we can support something that looks like this, ideally the move is for an equal high. If we can test these equal highs, because we've tested after a major higher low from here to here, a weekly higher low at this point, I would be seeking some sort of continuation for a blue sky breakout, a Brigade bolt over 609.75 to move into blue sky territory. That's what I'm interested in from the daily perspective, and you could even call this some sort of bull flag on the daily, something that maybe looks along these lines right here. If we can get that follow through, I think the agenda is for higher in this market. We just do not have the expression of stronger sellers participating. Of course, to reevaluate this, to invalidate this bullish stance that I'm taking on the market right here, I would really need to see stronger sellers participate underneath the low of the deep seek move. I would need to see a lower high set below 595.85, and then we can start talking about the equal low to Monday of this week, and then perhaps something like a CPI gap close. To me, the odds of that are much lower at this point in time based on what we've seen so far. Let's take it down to the hourly time frame chart. We're already pretty zoomed in here, but the point I want to illustrate is just a very clean hold of all the technical levels. If I just do something that looks like this, and we can even bring in the Tuesday high, what I want to illustrate is that previous support was the first place where sellers could have used that as resistance. Did it take place? The answer is no. And you can actually see in the 4th hourly bar of Monday, we set a higher low there. This does exactly as it should. We have previous support, resistance, resistance. First test, it acts as resistance. But then into the Tuesday afternoon, you can see that it acts as support. It acts as support again this morning. And then here, you see this prior area of resistance breaks out, and we have the highest high in the hourly trend count. In the after hours, we're currently suggesting some sort of mild gap up right now. We're trading 604.83 by 96. That'll continue to move. Of course, there's a lot of time between now and 9:30 when the bell ultimately rings. But how do you envision that the next best higher low could be produced on the hourly chart? It should be very, very clear. Obviously, it's 602. If we get something that looks like this, awesome. Brigade bolt to the upside, we would look to be buyers off of 602. Now, on a personal anecdote side, and this is maybe why today has been such a late video, is trying to stay away from the market here. I was one of the people who tried to short the market here, and I'll own up to this for sure. I had thought, okay, if we're going to use the Tuesday afternoon as overhead supply, if we're going to reject back down underneath the overhead supply from the deep seek move, I tried the short on the 5-minute. You can go and check this out. There's a bear flag that set up underneath 599.65. So if I myself am getting stopped out of short trades, which seemingly made logical sense at the time, then how do we feel longer term shorts are thinking about the same pattern, the same potential execution? Well, we're not holding with all of this as overhead supply. Once again, it all harkens back to what we just described in the daily time frame chart, that there really hasn't been any expression of stronger sellers looking to move the market lower with a firm agenda to do so. It just hasn't taken place. From a pattern perspective, it would have been something along these lines, like a head and shoulders, where this is the trapped overhead supply. You break the neckline, maybe we go back to the scene of the crime. It didn't take place, right? And that's just the reality of the market that we're dealing with. So right now, it's all about seeking longs, the base case living on with the strong recapture, not only just today in the morning session, but Tuesday as well, back over 599.65. I think that the ship has sailed basically for stronger sellers to try to make a stand here. I will reevaluate the tone, and I will, of course, dial back the bullish sentiment if we get, at this point, back down underneath this level here. Still seeking a higher low. I would say it's okay if we get something that looks like this. It's okay, this would be even better, of course, as we've described already. Opening drive to the upside might get a little bit tricky to participate on early in the Thursday session, so I would seek some sort of then like higher low pullback here, equal high reattempt, and then Brigade bolts here, intraday, 5-minute charts, 15-minute charts, right, to get some sort of move into the all-time high. That's what we have to the upside. To the downside, one more time, I'd be a little bit more neutral through this. I would definitely change my tone to being more bearish underneath 595.85, somewhere in here. I would think that, okay, why are we not holding up over the key level that we've talked about in today's episode thus far? Let's quickly take out the intraday anchored view apps. I just want to show you that we're back above the entirety of the stack. We do something that looks like this. This is the low of the move. Before the CPI gap up, we have one anchored to the deep seek move. We have the high, and we have the low from the tariff move as well. All of these not moving averages, but rather anchored view apps will be converging right around that 599.65, really reinforcing the idea that any sort of pullbacks that hold this zone really are more bullish than they are bearish. Let's take a look at the internals. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. What we want to take a look at is really the Monday move, right? If I just zoom back out on this, we can see Monday. Here's the gap down. It was such a severe gap that it's not a shock to me that overall the internals read bearish here, they read bearish here, and this technically reads bearish as well out of the cumulative tick. But generally speaking, what I would focus on, because of course the prior day's settlement was so far away, of course these internals are going to read bearish. They read bearish, they're printing red reads as long as we're underneath the previous day's close. So what we want to focus on is what actually happened relative to that day's open. If you look at the index score, this is why I call this one the Holy Grail. It's because it measures from the opening print. The index score was pretty positive throughout the afternoon session as this consolidation was taking place. As we move forward to the Tuesday session and we have a reasonable reset, so to speak, as in where we're opening relative to the previous day's settlement, at that point, right, internals do what? Pretty bullish on Tuesday, pretty bullish today out of the advanced decline line, volume inflows, strong cumulative tick, strong cumulative tick. So at the exchange level, is there any expression of stronger sellers? I'm not seeing it here based on the internals, right? You take it this one step further, and we sort of talked about this on the hourly chart on the SPY. It's the same concept here on the ES. We had talked about 60-50, right? So far on the Wednesday open, being under 60-50, that's where the sellers could have kept things at least neutral. Bearish was really more so underneath 6,000, but clearly what took place? Break, higher low over the Tuesday high, and rally to close at the high of day on bullish internals, and on bullish internals here out of the tick as well. So not really seeing evidence of those sellers. Let's take it on over to the market profile. What do we see from this perspective? If you're not familiar with this type of chart, check out the video tutorial in the top right-hand corner. You can see that today we actually produced a double distribution, meaning that we have upper distribution number 1 and lower distribution number 2. As long as price can stay in the upper distribution as we move forward here, and ideally value area as well, value area continues to exist overlapping to up to the upper distribution, that is bullish. If we take a look at the value area and the point of control from today's session, it is in the upper distribution as well. So that strikes me as buyers continuing to find acceptance at these higher prices, not some sort of rejection underneath the overhead supply that we've been talking about from the DeepSeek move last week, right? We opened underneath all of those traders, and yet price is still finding acceptance higher. We're finding that equilibrium higher, which is technically bullish, right? So value on an individualized sort of basis, if you look at Monday, if you look at Tuesday's session here, if you look at the point of control, completely outside of and above the prior day's range, outside of and above the prior day's range. The poor high, the improper end of the auction here has been repaired as of today's session, and we technically have a little bit of a spike in M period from today, but if we can sustain some sort of gap up, the gap rules will sort of supersede the spike rules as we move into Thursday. Let's get back on over the platform over here, and let's check in on our good friend, the QQQ. So the game plan should be pretty straightforward, right? On the SPY, we're seeking some continuation or progression of the daily trend in the upward direction, and to do that, we're looking for the equal high over time. Remember that this is okay, and I would really argue that you want to be neutral here, continuing to entertain this idea. We will change our tone if we see a breakdown underneath 595.85. Let's move along to the QQQ at this point in time. What do we see out of this chart? Certainly a little bit more neutral than the S&P 500. We do still have some semblance of a higher low from here to here, and a lot of traders, and rightfully so possibly, are calling for inverted head and shoulders, which is fine. But to really validate that pattern, what do you want to see happen? You just need to get out of this box. You could draw the top of the range here, 528. I would say that that's pretty substantial given what's happening with the Friday session of last week. Or you could sort of call it in here at 533.25. I would really change my tone to being more bullish instead of neutral on the range if we were to get price acceptance here, something very similar to what happened on these three bars from in the past. If we find acceptance over 528, then really none of this can act as overhead supply. We're above it, it's demand underneath us, and we'll seek the all-time high, right? That would be up here at 539. So really not that bearish out of the QQQ, which is very interesting to me given what's going on with Google earnings. Big gap down today. AMD took a little bit of a nosedive. The only thing that's sort of supporting the case maybe for higher is that although Google gapped down on earnings, they did mention a whole ton of spend on AI infrastructure. So your semiconductors did quite well today. You could look to names like AVGO, obviously NVIDIA, not AMD. AMD explicitly said, Lisa said in the call, like, hey, we're not really doing so hot on AI. It's almost like NVIDIA just siphoned the money out of AMD. So anyhow, getting back to the index, from a price level perspective, you actually didn't take out the DeepSeek low. You produced a higher low, if you want to get very granular. It's a higher low on the count from the DeepSeek Monday to the tariff Monday, we could call it. 2 failed Black Mondays where all the bears came out of the woodwork and said, oh, it's going to crash and go to zero. 2 failed Black Mondays. Where's the third? So higher low if you want to get hair splitting around the level, but still just a hold of 510, bullish inside the range, or at least just not bearish. Let's frame it that way. Even if you didn't want to be bullish down here, it's not bearish as we're holding 510, right? Back at the top of the range, I think that we just want to be cognizant of risk reward, right? Just like from a swing perspective, you want risk reward on a balance range. Well, you also want risk reward to the downside on a balance range. So depending on how strong or not so strong, weak, I suppose, the market opens up on the Thursday session, and depending on how Amazon earnings go after the close on Thursday, I would say that the next best thing that could happen here out of the QQQ is we continue to sustain some higher lows by staying over 518. 518 on the daily time frame chart is the next big step. Set the higher low, Brigade bolt out of 528. Maybe we spend some consolidation in here, and then ultimately it's the all-time high. That's the bullish continuation that I can see on the daily time frame. If it's going to be bearish, I would not be bearish under 518. I would just still be neutral inside of this balance range, and we'll just call it for what it is, right? The daily trend is neutral in here, because technically you could still count that you have highs, you have lower highs. Maybe this is a lower high. Maybe we set a lower high here, right? So still neutral on the daily trend count, but if we were to break underneath 510, that's where I think, okay, starts to get a little bit more dicey and we test the weekly level. Let's go out to a weekly chart here on the QQQ just to remind everybody that, this is now, how many weeks of balance do we have? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. 11 weeks of balance over the previous all-time high here. incredible, right? If you take the classic balance rules, we know that balance leads to excess. Let's call that the weekly balance. We typically look for a range double. I'm just going to use round numbers here, so please don't get too hung up on the math. You could do the math on your own, but let's call it 500 to 540, a 40-point range. That would project to the upside 580. If this were to break out as a bull flag, just a doubling of the flag itself is to 580. Never mind the flag pull, which we could just quickly, and the point of this exercise is not to be, oh my goodness, we're going to 580 by Friday. Matt was talking about a bull flag breakout. That's not the point. But absolutely do not come comment back on this video. Oh, we didn't make it to 580. That's not the point, right? The bull flag measured move is 615, let's call it, for round number's sake. Pretty incredible if this were to resolve in the upward direction. So we're talking about potential here. We're talking about the fact that the broad market is not as bearish as it could have been. We're talking about the fact that the tariff gap down did not set a lower low in the technology-heavy NASDAQ side of the market. It did in the S&P, but there was a prompt recovery, and we're already back in alignment with the base case we've been dealing with for a little while now. Let's take it on down to the hourly time frame chart here. Let's get a little bit more granular. You can see again the beautiful hold of what could have potentially acted as a rejection on Monday, acting as support here Tuesday morning for the opening drive to the upside, and even into the Wednesday afternoon. Notice the prior highs, previous rejections here, acted as support into the afternoon. So from the hourly perspective, show me an hourly bull flag here, right? This sort of turns into the flagpole. Here's your flag consolidation. This break and Brigade bolt over 528. Count me in, coach. We're looking for some upside, right? There really wasn't much of a short opportunity out of the QQQ NASDAQ side of anything this morning, just being so middled inside of the overall range here and not testing that key 518. So at this point, really not seeing any expression of stronger sellers in the NASDAQ either. My first thought is for continued upside with respect. Let's bring it back, right? So that way we satisfy all the perspectives here. Let's not lose sight, and I have to double check myself, right? Let's not lose sight that this is a balance range. We're approaching the top end of the balance range, and it wouldn't be unreasonable. Let's frame it that way. It wouldn't be unreasonable, given that we're sort of in this kangaroo market, that maybe longing it directly into resistance at 528 is not the best idea in the world. So how do we participate in that? Show me the consolidation. Show me the Brigade bolt. When I say Brigade bolt, I'm talking about a higher low hold over 528, at least something that we can execute on. 5-minute chart, 15-minute chart, 2-minute chart for quick draw McGraw, right? If we can do something that looks like that, that's where that trade is valid. If we're just chopping around in here, you're not preemptively assuming that 528 is going to break out and lead to big upside, because at that stage, it still has the potential to act as resistance, right? So in that case, do you want to short this? Maybe it's a Brigade bolt here to the downside. I mean, the risk-reward location might make a little bit more sense, but I really don't see the evidence of stronger sellers participating here. I don't know that we really want to try too hard for that short, right? Because, yes, we did move from the top end of the range to the bottom end of the range, but why did this move take place, right? We had a catalyst behind that move. It was not just like pure auction dynamics or, okay, buyers and sellers found an equilibrium. We needed new price exploration, price discovery to the downside, and price went. No, we had over the weekend news that gapped us down to the low. How about from back here? We had over the weekend news that gapped us down to the low. So it's not that intraday shorts have been lucrative by any stretch of the imagination. With that, we will throw on the Anchored View app cluster here out of the QQQ. You'll just notice that you're above the entirety of the stack. And once again, that does strike me as a bullish data point. Here are the market internals for the NASDAQ side of things. We can see very similar to the S&P, where on Monday, via the large gap down, that's where the sellers maybe could have had something going on, but recall that it's really just because of the discrepancy between the close on the Friday session and the open here. So, of course, everything at the exchange level is going to read as red. This actually makes it back into trend lower zone from way over correlated to the downside. Cumulative build's not that bad. What do we have out of the follow-up sessions to the upside? Strong volume inflows on Tuesday, decent on today's Wednesday session, in-trend higher zone to close on Tuesday. Wednesday gets pretty darn close. Decent, well, I shouldn't say decent, really strong build out of Tuesday's cumulative. Today, a little bit lackluster. It's not enough to go out there and short the market with both hands. But again, the illustration here is that the buyers are stepping up in this market environment. Let's take it on over to the NASDAQ side of the market profile. And what do we see over here is just simply, come on, There we go. It's the same thing, double distribution, 1 and 2, and as long as we spend time in the upper distribution, that is pretty bullish. We've repaired this lack of material excess. The point of control is in the upper distribution here. Value is overlapping to up on it. Really not much of a concern for this market as long as the NASDAQ sustains price acceptance over roughly like 21.7. 21.7 is that next key level. If price is above, I would really maintain more of that bullish stance. If we fall underneath, a little bit more neutral, taking it step by step, and there's the potential for some sort of reversal if we start taking out the low. Let's go back on over to the candlestick chart just so I can be very, very clear in how that happens, right? That's this right here at 524.75. If you get some sort of Brigade bolt here, again, I'm not seeing the evidence that stronger shorts are participating. This would not be a primary outcome that I'm looking for, but that wouldn't be unreasonable from a risk-reward perspective, looking for the potential downside. The last comment I'll make about the NASDAQ, which I should have made earlier, is just that the entirety of the tariff gap closed on the Monday session. Here's Monday's high of day. Let me remove those VWAPs for you here. You can see the Monday high of day is on par with the Friday low. Friday's low, Monday's high. So the gap closed in one session versus the S&P, which took 2 sessions. So even, that's as well a more bullish indication here on the QQQ. Enough about that. Let's jump on into our Rusty Russell, the small caps. Let's keep this show on the road. And I've got to say, color me impressed. We had a pretty rocky start to the week, gapping back down underneath the big weekly level here at 227. We all know that previous resistance acted as support. Resistance, New Balance range over here, hashtag not sponsored. We opened on the big gap down underneath the weekly level as well as the New Balance lows as well. So again, just walk through this from a psychological perspective. If you have stronger sellers participating in the auction, then we really should have seen a number of lower high attempts, either just opening drive to the downside. You could have seen partial gap fill reversal, rejecting underneath 223.75. You could have seen full gap fill reversal, which started to look reasonable based on Monday's upper wick. Tuesday invalidates that, and today totally validates that buyers might actually be stepping up here for something more impressive on the weekly time frame, getting back up and over that 227. Notice that the gap closed to the downside, and then we closed at the high of day over the daily 50 SMA. And what's most compelling about this, I mentioned this in the very beginning, the intro of today's episode, is that the market doesn't really care about the Fed, and the segue there is just that the Fed is closely tied to the labor market and what's happening with inflation. And today on Tuesday we had JOLTS. On today's session, we had the ADP non-farm preview. Both of those numbers suggest that the labor market is doing A-okay. It's fine, which in theory means that the Fed keeps rates higher for longer, which typically is not too great for equities, specifically small caps. Yet, what's happening here, right? The market doesn't care. The market does not care one bit. Doesn't care about Google earnings taking a hit, doesn't care about the Fed, doesn't care about the labor market, doesn't care about inflation, doesn't care about tariffs, doesn't care about anything. Just cares about the fact that stronger buyers are, they're exhibiting price acceptance, or they're pushing the auction higher. So that's all for the IWM on the gap fill reversal over 227. Looks pretty darn good to me over that level. Let's take a look. It's not out of the woods. Let's be honest with ourselves. It still needs to break out up and over these highs at 230. This level could rightfully so be adjusted a little bit. Let's zoom back out and see. This is the origin. This is the scene of the crime from the Powell plunge back over here. So I'd still use that as a key level, but we probably could reinforce it with 230 spot on the money. Thank you, Thinkorswim, for giving me the nice round, easy number. Let's try to dim this back in real time. Thanks for bearing with me on a late night episode of the Midweek Market Update. So just walking forward, ideas here are consolidation, look bullish. Brigade bolts over 230 are bullish. I will change my tone back to neutral through here and absolutely bearish again underneath 223.75. Remember that the Russell accepting prices underneath 227 was a headwind for the S&P 500. So does this align with the thesis we've set forth so far, such that, okay, if progress is going to be made in the upward direction, is this a step in the right direction from the Rusty Russell? Of course it is. Of course it is. So looking good here over the 227. We can throw on the intraday anchored VWAPs just to be congruent with all of the analysis. Notice how they're clustering here underneath 227, continuing to act as potential support as we move forward into the future. Here is the Russell internals. Here are the Russell internals. We have a rinse and repeat of everything we've said so far, Monday was the chance for the sellers to make something happen. Obviously, it didn't, and we do see some decent follow-up on Tuesday. Wednesday is a little iffy, pretty flat out of the cumulative build, but keep in mind that the gap fill reversal speaks magnitudes there, just in the sense that if stronger sellers were going to make something happen, it should have just been weak consolidation on the lows. It should not have been a reversal off that. It should have been acceptance underneath 227. Didn't happen. We closed at the high of day. So buyers definitely trying to flex that muscle, and we'll see how we come into tomorrow's session. Let's come into the market profile for the Rusty Russell, and we do not have a double distribution over here. The point that we need to make on this chart, though, is just that we have value progressively moving higher, accepting towards the top end of these ranges. Notice point of control here is, it's over the midpoint of the range. That's the purple line, but definitely slammed towards the highs on Tuesday, right smack on the highs from today's session. So once again, do we have price acceptance near those highs? Are buyers making progress in the upward direction that's sustainable? To me, the answer is absolutely, based on what's happening with market profile and value. Let's jump on through the hoops of our S&P sectors. Let's see what's going on. Weekly performance, who's leading, who's losing, where is the weight? Semiconductors doing quite well with NVIDIA and AVGO, Broadcom, pulling a lot of the weight after the comments from Google's earnings call last night. We have the XLK sector doing quite well also. That's the heaviest weight risk on sector. The semiconductors are sort of like a sub-industry, if you will. We have energy up towards the top of the list, up 2.97%. Then we have real estate and utilities. Typically utilities a little bit more deeper defensive, real estate hard assets a little bit more defensive as well. Energy is kind of neutral, but the fact that semiconductors and tech are both outperforming and, by basically a full percentage point on each, that's pretty substantial to me, and that does appear to be more risk on than risk off. Notice also that there's not a single sector that's red on the week, right? At the bottom end of the barrel, the laggards are industrials, discretionary, that's going to change based on Amazon earnings, as well as consumer staples. Consumer staples are D for defensive, but it would be great if discretionary could work its way up the list here. I do want to call out that financials are performing quite well as well. That's up 1.83%. Quickly looking through the structural charts, the SMH holds on to the bottom end of its range. The tariff gap down did not jeopardize the base case low from the DeepSeek stuff. Makes sense. Obviously, DeepSeek is much more sensitive to the whole conversation around semiconductors, AI, training models, data centers, the whole nine yards. So, liking the fact that 237 is holding, this balance range, is still exactly just that. It's a balance range until proven otherwise, and we're in the midpoint. So, I'm not ready to say okay, let's fire everything on all cylinders and it's up and away we go. But it's definitely a decent hold of the bottom end of the range. So I would frame this as being not bearish and probably leaning a little bit more bullish with the potential for a higher low and holding the bottom end of the range. And when I say potential for bullish outcomes, I'm really thinking about maybe some sort of gap close to the upside over 251.50, 260.30 becomes the target on that. Let's check in with the XLK, the tech sector, the heaviest weight sector of them all. Nice little recovery effort off of the lows, 3 days straight up in the upward direction, of course. So consolidation that holds up over 230.25 eventually looks for the gap to close overhead, and that would keep us bullish here, or at least, again, not bearish. I think that's an important distinction to make. What would be bullish is finally some sort of repair up and over the all-time high. I mean, this is just incredibly weak price action near those highs. It's the improper end of the auction. We need something over 242, more of an excess high, to say that that has been complete. So I am still carrying that forward in the narrative, and 230.25 is your key support into the end of the week. Let's move along to the XLE. The sine wave is compressing a little bit. Maybe we're building out some kind of wedge. Not a big fan of trading wedges, but energy, we'll be more concerned when and if it makes a big new swing high or a swing low. As of right now, the compression strikes me as neutral. Let's move along to real estate. Rate sensitive. Rates fell off of a cliff today. I guess just the understanding that, hey, maybe this tariff thing is not going to be inflationary. We'll take a look at the TNX in just a moment. But of course, with rates down, real estate's up, and that's fine. But we're still under this overhead supply. You guys know the deal. We've been checking in on the XHB. Home builders, a little bit of an uptick here, but not by much. I mean, the gap down on Monday is still offering a lower high potentially underneath this overhead supply, which is already a weekly lower high underneath overhead supply. So a little concerned about the cyclical side of the economy. We're probably in a new regime, right, where technology just dictates everything anyhow. So the XLK sector is clearly going to overshadow what's happening with the XHB, but worth talking about. Let's move along to utilities. Lightweight sector, also D for defensive, inside of its balance range from here. So that's a step in the right direction, trying to build out some semblance of higher lows. Upward pressure is still upward pressure. Let's not lose sight of that. Financials look absolutely phenomenal. I have not, financials almost appear as though they're the backbone of this rally, holding at least neutral and putting the upward pressure in. When tech slips, financials are right there to catch them, right? And you can see the beautiful higher low in the trend count. You can see that we have this consolidation near the all-time highs, looking for that Brigade bolt to get follow through in the upward direction. Moving along to the XLV, what's going on with healthcare? A great little recovery effort happening over here. High and tight flag consolidation in this box, and getting some follow-through on today's session. Fourth heaviest weight sector for the S&P. Even with Novo Nordisk not really performing so well, we have Eli Lilly earnings tomorrow morning that could be influential over this sector as a whole, but pretty impressed with what's going on. Let me just double check that Novo was Novo the gap up, actually? Novo was a gap up. My apologies. I'm thinking of Uber. There were a couple straggler names that I was kind of keeping tabs on. But anyways, there's Novo on the gap up. And of course, that was helping the case. I want to make sure I was not leading you astray there. Wouldn't that be embarrassing? So we have Novo applying upward pressure. We'll see how Eli Lilly comes out. Is Eli even moving on the news? Let's see. Yeah, drug makers. Both of them, right? So getting a little bit of that follow through in the upward direction, breaking out of this bull flag. It looks pretty good ahead of earnings. If I'm being honest, you have this 850 possible breakout level to close the gap. This is not one of the individual trade ideas I had for you, but as we're on the topic of the XLV, it's certainly a chart to pay attention to, right? You have this big time weekly double bottom. We'll see how earnings come out. Could be the fuel to the fire to get into the gap, therefore gap fill reversal. It's like close the gap below to close the gap above. If we gap down, that's fine. Ideally, you just set some sort of weekly high or low, and over time this builds out as a triangle instead of a double bottom. So pretty interested in that LLY chart now that we take a look. Let's move along to the TLT. Rates, as we said, moved aggressively in the downward direction. So there's your TLT breaking out higher, which again is a little bit of a head scratcher. Markets responded poorly to the, seemingly okay. Markets responded favorably to the seemingly bad news on JOLTS, and yet this morning when we got the good news on ADP non-farm, markets still responded favorably with lower rates. So a little bit of a head scratcher there. I don't think we're fully out of the woods for what we should expect on Friday. We'll talk about the fundamentals in a moment, but I will just let you know that the puts are likely to expire worthless at this point. They go out on Friday. They're the 85, 84, and 83 strike, and those are likely going to get closed out for 2 pennies as we come into Thursday and Friday session. I'll have some resting orders out there, and that'll be a nice little trade. That swing trade will be complete, and you guys have followed along since the inception of that trade, which was really back over here. So that's that. Let's move along to the XLC. What do we have out of communications? New all-time highs, looking pretty darn good here. Any higher low consolidation or acceptance over 99.15 keeps that chart in an uptrend. Bullish, no concerns. Google's gap down did not decimate the chart, and Netflix is actually trying to break out of its earnings range, and we'll get to that in just a moment. Materials inside of its prior balance. We've already talked about how home builders play into that narrative there. If we look at consumer staples, a little bit of a lower high rejection happening there. It's still up off of the lows, but I would just be mindful of the opportunity for a potential weekly lower high at the moving average cluster. That's 80 to 70, 79, 70. There we go. Discretionary. Amazon earnings on Thursday after the close, so tomorrow, will absolutely influence this name. So ideally, it's consolidation that Brigade bolts to the upside. Amazon's been a powerhouse over the last little bit. I'm almost less concerned about Amazon earnings, and I'm more concerned about Tesla. Can Tesla get in gear or what? Tesla is it the second heaviest weight or the heaviest weight? I can't remember exactly where it falls in the breakdown. Tesla's second heaviest weight, Amazon the first. There we go. So 16, let's call it 17%. Tesla cannot get in gear. No pun intended. Those electric vehicles, man, just terrible. It can't get in gear. Show me this, show me this. We need Tesla to participate. And as of right now, take a look at the core list of companies. Outside of Amazon, it was the only other red name more substantially down. It's down 2.41%. Come on. So you need some performance there. You need some play out of Tesla. And unfortunately, the daily chart, and we'll talk more about this as we get to the core list of companies, looks more like a threat to the downside than it does upside. So XLY could be a laggard here over the next little bit. Industrials look pretty good. Potential for a higher low inside bars after the tariff gap down. So ideally, it's a Brigade bolt here to put the upward pressure back on, and we have ourselves a weekly higher low on the table. Let's move through our ratio grid and see what's happening from this perspective. And if you're not familiar with the ratio charts in Thinkorswim, check out the video tutorial in the top right-hand corner. This is still concerning. We've known that ever since it broke down more aggressively, that's the deep seek move, that this was kind of a red flag. So let's say neutral to red flag here. This still looks okay, but Tesla's becoming a thorn in the side. Financials are really carrying the weight with the relative strength. Bull flag up here, a break of that, pressuring new highs. That's bullish, and that's still risk on. If I look at the risk off sectors, which are going to be your consumer staples, here, and the utility sector, they're not aggressively in uptrends, although they are flattening out. I would just be mindful of the flattening that's taking place. So it's still more of a risk-on environment than anything else, with some sort of struggles over here out of the tech sector. Let's move into our specialized ratios to see this here in a different expression. It's the same thing. The tech still sort of struggling a little bit, but if you look at apples to apples, discretionary versus staples, still looks risk-on here. Semiconductors versus healthcare. With the healthcare recovery, this chart is really underperforming. Here's the deep seek move. Obviously, healthcare has been almost straight up since then. So that's that. But if you look at the very bottom, we've updated this chart, right? It's ARK, so Cathie Wood's Innovation Fund, versus the S&P 500. And notice that it's breaking out. So why have I included this in the lineup here? Simply because if investors feel good about risk-on assets, the ARK Innovation Fund is basically the embodiment of that. And ARK Innovation is outperforming the S&P, breaking out of this range over the last couple of sessions. I mean, you could even go as far as saying we have a Brigade bolt here. There it is. There's the higher low over the breakout level. So looking pretty good out of ARK. Thanks, Cathie Woods, for that one, although AMD is not performing so well. So anyhow, ARK, risk-on signal happening from that chart. Let's move into some fundamentals. We've got the dollar collapsing on the reversal of the tariff news, of course, which as we take a look at the TNX, of course, is going to mirror the same thing. Here we go. 10-year rates dropping off of a cliff. The weekly is still just an opportunity for a higher low pullback. Keep that in mind. We did close, at least on Wednesday, underneath the level. We'll see how the weekly bar closes as a whole. But for now, daily is absolutely triggering, the head and shoulders pattern. We're under the neckline. It's very possible that a new daily downtrend is enough to potentially, mirror the pattern here on the weekly. That's what it would have to look like there. Even if Powell just holds rates higher for longer but stable, if the forecast is for cuts still in the future at some point, as long as inflation doesn't see aggressive upticks and there's no need to, reinitiate a hiking cycle, then I could easily see an equilibrium forming out of interest rates. So thinking about that, the higher neutral rate could be, the market could be attempting to find that higher neutral rate. Let's move along to gold. We sort of skimmed over gold. We should have tied this to the dollar, but that's okay. Here's gold relative to the S&P breaking out. So this is the only thing across everything I can see. It's the only thing that's still somewhat suggesting like, okay, not everything's all fine and dandy. It's gold relative to the broad market. And, both of these charts in isolation look okay. We know that this is a very clean uptrend in gold, but we've talked about how the S&P 500 is trying to find some higher low here. If the S&P was more aggressively in a downtrend, or if it looked like it had the potential to change aggressively, I would be more concerned, but it's just not. And this is the only inflation gauge or sort of risk-off flight to safety metric that it looks concerning right now. We could take a look at interest rates breaking down. Basically, we already looked at this chart, I know, but what is this an expression of? It's an expression of a lack of fear about further inflation, right? If you take a look at, let's get through the fundamentals, but the bonds relative to themselves breaking through the 50 SMAs, setting these lows, that's also an expression of a lack of fear about future inflation. So let's go to the inverted ZT, and then we'll get through the remainder of the risk appetite settings, or charts, I should say. We're sideways out of that, meaning that the bond market is not suggesting a hike from Jerome Powell again, which aligns totally with what we can see out of the Fed tracker tool here. Current odds stand at an 83.5% chance of a pause in the March meeting. Remember that there is not one in February, so all set on that. These odds will likely shift a little bit further again on the Friday session when we get the full labor report, and we'll talk about that in just a moment. But what you'll also notice here is cut number 1, cut number 2 is into the end of 2025. And then there was some weird pricing going on with the Fed Fund futures. But finally, this is actually resolved to another cut by the end of 2026. So it's not about whether or not we actually see this path play out. It's just tracking the sentiment of the market right now, which is not overly concerned with inflation, right? Which is very interesting. Let's take a look at the calendar. This is that first semblance of bad news here out of the labor market, causing upside in the market, right? On Tuesday, the market sort of rallied once the JOLTS numbers came out. It opened in the midpoint of that range. Tuesday rallied up towards the top end of 60.50 in the ES futures. That's right on the heels of JOLTS, right? As we look forward to the ADP non-farm, so that would have been the classic indication of bad news is good news for the market. ADP non-farm this morning at 8:15, we beat the expectations here, 183 versus 148. And the market does what? It still ends up rallying on today's session. So in this case, good news actually was good news. I think what's basically happening here, and you can leave some comments down below. This is always where it's a little bit more fun to go back and forth about perceptions and ideas about the market. But I think the market's actually just very content with a strong labor market, not worrying about an unemployment recession, and not so obsessed with the idea that rates need to come down like right here, right now. Donald Trump actually, in a follow-up after the FOMC last Wednesday, said that he had thought Jerome Powell made the correct call by not cutting rates, which is just, it's almost crazy to think, because just days before he was saying interest rates are going to come down and we're going to demand that they come down, right? And then he praises Jerome Powell for holding his resolve. Interesting, and again, we can talk about all this stuff in the comments, that's fine, but the point being is that the market certainly does not perceive that a massive wave of unemployment is on the horizon, right? And that's simply what we're seeing out of the Fed tracker tool in combination with this over here. And the market's not worried about it. It likes to see that resilient labor market more so than the sick and twisted backwardation where, okay, bad news is good news, so on and so forth. This morning, we also get ISM services PMIs. We'll talk about that right about now. Talk about that right about now. There we go. Here's the right screen. So when it comes to inflation, right, this is inflationary. When you see an uptick out of prices paid, that's ISM services prices paid in orange. And then you have a flat move out of the blue, which is new orders, non-manufacturing new orders, services basically. So the fact that both of these move in the downward direction means that, number one, things are in theory getting cheaper, right? But it's also happening with fewer orders. So less of an inflationary pressure. So it starts to make sense as to why 10-year rates fell off of a cliff today based on ISM services, prices paid, and new orders received. This was the JOLTS metrics, which I did want to bring up just to indicate that JOLTS are all over the place. I mean, it's very typical that you have some months of JOLTS up, JOLTS down. We've basically stabilized, and I don't know if I have this loaded up as a grid over here. It looks like I don't, but if you look at JOLTS, we could probably find it back over in this section of the chart. Here we go. There's JOLTS. JOLTS is just renormalized, right? Here's pre-sickness, I guess we could say it now, pandemic, right? We've pulled back to that level. JOLTS is normalized. This is a normal and healthy labor market. This is not out of the blue. This is not unreasonable, right? So that's what we've got out of that metric. We can go back over to the calendar. We can talk about what's on tap for the remainder of the week. At this point, jobless claims on Thursday won't really influence what happens on Friday. Reason being is that all of your January reads are already priced in, of course, or, quotes, priced in. They've impacted the report already. So this isn't all that influential. It's maybe a forward-looking statement, but it's not going to help us understand what happens on Friday. Unemployment claims are a non-issue, which means I would expect a 4.1, if not a 4%, if not maybe like a 4.2, anything in that range between 4% and 4.2%, no problem out of the labor market here. The ADP non-farm preview tells us that we should expect a beat on the employment number, and hourly earnings does not look like we are in a wage price spiral here either. So all set across the board from a labor perspective. The market's sort of like, as I said in the intro, it just doesn't care anymore about these things. It's like it's totally accepted the idea that from a fundamental perspective, we're all set. Non-issue. Here's the earnings calendar. AMD, Alphabet, both gapping down as we talked about prior. PayPal also got hit pretty hard there. Uber gap down, not by much, but technically a gap down. Disney I didn't look at. Novo we just saw was up. After the bell, it looks like Qualcomm and ARM are also down. Now the commentary I want to display here is just that the market is punishing forward guidance. The numbers can come in fine, but forward guidance, if it's off by a hair, the market is punishing that quite a bit. So I think what this sets us up for is if in the next earnings cycle there are big beats of the actual numbers, now you're going to start to see some catalysts that really send the market on its way. So think about how this sets the stage for the future fundamentals or expectations of the market's expectations of the company's fundamentals for the next cycle once these guidance reads are out, these guidance reports are out. And so far the guidance would suggest if it's weak, right, any sort of beat there should send things higher. Anyhow, that's some commentary on that, and it's not a surprise that Qualcomm and ARM are suggesting weaker guidance going forward after what's just happened with DeepSeek and everything we're seeing from AMD. It would be really interesting to hear what NVIDIA has to say about this, Jensen and team, later on in the month. Amazon earnings after the close on Thursday, of course. We've spent too much time here. Fortinet's also an honorable mention. Let's get back on over the charts, and let's finish up this night's episode of the Midweek Market Update. Let's take a look at the TLT ratio to the S&P, a little bit of risk-off flavor happening over here. So this pairs a little bit more so with gold, but as we've said so far, rates falling off of a cliff does not really seem like it's a risk-off signal, the way that all of this is taking place. Let's get on over to credit spreads. Credit spreads will give us some more color here. Any issue from this? No. I mean, this is still technically offering a lower high. Ideally, this breaks down. But HYG side has already broken down aggressively for a lower high, already trading on the lower low. So not seeing a flight to safety out of credit spreads or just financial conditions really getting overly tight, so to speak there. Let's take a look at HYG in isolation. Strong recovery happening here. No problem. Looks like the tariff was well received, and we've already rallied back to the scene of the crime. So not overly concerned with HYG in isolation. We could take a look at Bitcoin as a risk appetite gauge. This certainly broke down underneath the previous week's low. The tariff news was pretty detrimental to Bitcoin. However, where are we trading? Still inside of the flag range. So I think that that's still an idea for a positive risk appetite in the market right now. Let's jump on over to, where's Total Breath? There it is. Total Breath looks fine. Sideways to up happening over here, sustaining all the comments that we've made through the weekend videos. RSP still well above and hold it. Look at that. Look at that. Put it in the textbooks. Put it in the textbooks. Previous resistance acts as newfound support. Perfect hold on the gap down 178. The breadth expansion rally can continue here. If you take a look at the QQQE, I would imagine it's very similar. Yep, there's your gap down holding over the top of the range. Looks great. We can move along to volatility. Getting crushed. Not a surprise over there with the rally we've seen the last couple of days. VVIX also moving back in the downward direction, but still elevated. Ideally, this would break underneath the 95 handle. If that takes place, we're probably looking at 75 over time. Not that you would apply classic technicals to that, but it is range bound. Here we go with the volatility futures and primarily our new holy grail up here towards the top. I love it. Absolutely love it. Notice on the peak fear of the move on the Monday gap down with the tariff news, we did not invert any of these relationships. The bright white line did not move underneath gray, dim gray didn't move underneath deeper gray, and basically non-visible on your screen is over the zero line the entire time as well. So volatility never inverted, never suggested, oh my goodness, you should sell this market and panic. Everything's going to zero. So pretty solid look out of those charts there. Let's take a look now through the core list of companies. We'll do a speed round over here, just being mindful of time. We have ourselves look below and fail starting to complete itself out of NVIDIA. I've got to say, a little disappointing to see that Tuesday upper wick there close underneath 119. Made our jobs a little bit more difficult, but the pattern nonetheless is still playing out. Look below and fail. We had talked about that quite a bit on X. If you're not following us on X, you should go do that. We post a bunch of setups after the close every day. Here's Microsoft. Microsoft looks like it could be finding support near the bottom end of its range. Lows, lows, and lows. I would not jump the gun on this, and here it is in the hourly time frame chart. It needs to show you something clean up and over this 414.50. You can see the multi-day range that's been developed. It needs to show you this with a very clean way to participate, risk reward, and then we'll look for that 423. If that takes place, great. If it doesn't and we just drift off into the oblivion, I'm equally okay with shorting this. I would probably actually prefer to short this underneath 411.25 into 403. Matt, you just said that the broad market was bullish. Well, Microsoft has not been playing nicely with the broad market for a very long time. Notice that this is just in a balance range, and it's been like that for nearly the entirety of the year. You could go back further. It's been more than a year. So really thinking that if Microsoft's going to expand range, there's the potential for it for downside, but I just don't want to be premature if we have back-to-back hammers, lower wicks, starting to show some signs of support near the equal low. It needs to be clean on either side of those two key levels. Next up, Apple. Apple's been a little bit tricky here. I have not really liked trading this one this week at all. Reason being is that the move to the downside I was looking to participate in was really what unfolded from the gap down this morning, and it instantly got bought back up, right? The idea here was that, okay, we have a 100% retracement. This was going to set a lower high. Risk reward to the downside was the idea. We ended up opening on a gap down halfway to the target. That's no good. So as of right now, I think it's a patience play. I don't think that there's anything obvious to do with this chart. If there does start to become some sort of like look above and fail with a lower high, I would still entertain the risk reward range that we were originally aiming at. It would just need a new setup here now that you have technically lows and higher lows on the hourly. Don't ignore that is technically a higher low. And in theory, if a new uptrend is going to build, all it needs is a higher high. Right, and holds here are bullish, looking for upside technically. Not that there's necessarily an easy trade there, but the failure is required if you're going to trade it to the short side underneath 232.15. Next up, Amazon. Earnings on Thursday after the close mean that this is pretty much invalid for us options traders. Implied volatility is going to be way too pumped, so I'll just let this be. We'll let earnings pass, basically, and then we'll reevaluate after. I would love to see the technicals hold up and do something that looks like this. I would love to see, support here, Brigade bolt back above. These setups are attractive, but once again, with earnings, it's just one of those things where it's a wait and see at this point. Here's Google. I think that it's been a pretty devastating earnings report, or at least, the way that the chart responded to the earnings report, we'll frame it that way. So a lot of spend on AI infrastructure, and note this, right, is the midpoint of the range. It's also, if I zoom out, I don't know if it's going to show on the hourly chart still. Let's go back here to the daily. Previous high, midpoint of the range that we just refined, is technically where the gap struggled. So anything that remains underneath this 192.50 is technically more bearish, I would say, than bullish. And you could also make note that we had a failed breakout over the top end of the range here. The gap just totally decimated that. So for now, I'd say bearish consolidation persists here, and there's the possibility of closing this. This is the Willow Gap for anybody who remembers Quantum, that long lost theme. It's like everybody got way excited about it, and then poof, it drifted off into the oblivion. So that's the Willow Quantum Gap down below. If we were to break underneath 185.25, really, as unfortunate as it is to say out of Google, I don't think that there's much interesting to do here. If it Brigade bolts into the gap, that might be some sort of executable trade we can look for, just because the risk reward should be very well defined around 192.50. Next up, Metaverse. Really, really strong looking stock. However, everything good comes to an end at some point. And we have an inverted hammer at the very tippity top of the move on the daily. If we were to break underneath the lows, a range rotation to the bottom end seems reasonable. If you take a look over here, there's a nice morning pop, but then it faded quickly, and we are underneath the level, slightly above as of the close, but you get the idea. It's generally speaking, you could even refine this. For tomorrow's session, you would just use today's low, right? And you could call it, $700. At this point, let's not split hairs on a $700 product. Under 700, right, this lower high is a look above and fail on the balance range here. Target is 682.25. So if the broad market is bearish, and is pulling back, then maybe we'll entertain this meta idea. Otherwise, consolidation up here, just let it be. And we'll look for some potentially long idea, but very, very difficult to trade long into some sort of move that looks like this. Next up, we have Tesla, the beast of burden, as we had been talking about earlier on in the XLY. It looks horrible. I mean, it looks like descending triangle. Now, eventually at some point, Tesla will wake up. It'll be a good trader again. But I think until that actually takes place, it's day by day on the chart. This is a descending triangle until proven otherwise. We have highs, we have lower highs, we have lower highs, lower highs, lower highs on the gap down, basically. If we break these equal lows, there's really thin structure through here. And ideally, let's not lose sight and forget about what this is, right? The bigger retest of 358.50 is pretty good, right? We never got all the way there on this pullback over here. So if we can make it all the way to the retest of this level, let's, again, like I said, let's not lose sight of that. If we find buyers here, that's absolutely a place from a higher time frame perspective where we really want to try to navigate risk reward, something that looks like this, balloon runners back up towards the all-time high. That would be very interesting, right? And if you want a higher degree of confidence, maybe it's something that looks like this. you could start to call it, inverted head and shoulders or whatever with a higher low back over 377. Here it is in the hourly time frame chart. You can see the failure to accept inside of the gap from over here. This is one of the only names that has not more aggressively recaptured its tariff gap, right? Big downward pressure here. So 377, it's a must watch. If you break down underneath, I do think that there are short opportunities in Tesla into the remainder of this week. 358.50 is the big level on the downside. JP Morgan looks fantastic. We've talked about financials looking healthy, and this falls right into that category. Continued consolidation, Brigade bolts up and over 270. There's not much to say or do about it. It's just looking for upside pressure. Next up, Netflix breaking out of the earnings range, finally. A little bit of a fake out on the Tuesday session with that upper wick daily bar closed back underneath. But you guys know the name of the game. If you look back here, right, this could be the start of something big. We're over 1,000. If you want to take a classic range double approach here, you're probably looking at something around, 1050, right? So there's your upside idea out of Netflix. It looks like it's starting to trigger. It's all a matter of staying above 599 at this point in time. On the hourly chart, you can see it wasn't so clean, right, on the first test. So at this point, can't really afford to get back down underneath the level. You got to stay above and then look for that continuation in the upward direction. 3 trade ideas, and then you're on your way. The first one, healthcare-related MRK. Merrick. This, of course, is a gap trade. So you could see on earnings, the large gap down. Notice the inside bar, the hammer candle from today's session, over 90.95, looking for some of the gap to close overhead. Keep in mind that this is technically in an aggressive daily downtrend, and we're bottom fishing here. All right, so that means size your positions appropriately. It means pass on this if you're not someone who's good at sticking to a stop loss. If this continues to break down underneath, you got to step away. You got to step aside. You got to say, okay, it's in a downtrend. We tried the bottom fishing opportunity, didn't work out. Let it do its thing, right? Let it do its thing. So I like the hammers so far. I like the lower wicks. I like the inside bar. I like the gap overhead. It's just a matter of spotting the intraday setup that gives us the Brigade bolt. Show me the 5-minute higher low, the 15-minute higher low. That's what we'll try to look for out of this one. Obviously, Eli Lilly earnings could cause some sympathy here, but not to overuse the word obviously, with earnings out of the way already for Merrick, the damage has been done, so to speak. Next up, BA. Let's take a look at Boeing. Boeing is interesting here with the possibility of a bull flag that's broken out, trying to clear the highs of that flag. Yes, we have this funky upper wick, but I think that can actually tie into one of the trade ideas from the hourly chart. Let's actually pop this level in here together. We've got 187 flat. You guys know the rules. Round numbers only up here in the penthouse. If we can get some sort of Brigade bolt there, very thin structure retracement, breaking out of this range, hold over 181.50, I like it. I like it as a non-correlate, like it's not correlated to tech, right? I like it as an idea from that perspective. So BA, upside on that. And I'm also remembering a ticker that comes to mind from last night's X posts. I'll bring that one up in just a second as well. We'll check in on it. But AMD is technically the third idea that I had planned originally. And this is not a bottom fishing play. This is not a let's buy this at a discount play. This is a let's short this piece of garbage into the ground play. We're in a weekly downtrend, a daily downtrend, an hourly downtrend play. If you take a look at the hourly time frame chart, I don't know about you, we can actually just remove all of these drawings. They're basically irrelevant at this point. This is what I'm looking for, 113.40, 113.50. Close the gap all the way. Technically the gap close would actually be here at 114.75. These are close enough for round numbers, actually. Any sort of rejections in this area, I would just be looking at overhead supply to act as downside pressure here. Now, again, yes, we got a little bit, animated with the, let's short this thing into the ground, but let's be real. Let's wait for a setup. Let's make sure that there's something that shows us that sellers are stepping up. But generally, shorts have been rewarded and rewarded quite handsomely over the last little bit out of AMD. So watching that here, 114.75, 113.40 as a short zone. If we can set a lower high, looking for the drift back to the downside. The next trade idea, which may or may not be in play, but CRWD, CrowdStrike, yeah, it broke out today. So that's my fault for just not watching it. But 411, man, we talked about this level over on X yesterday. Excuse me. I was too was not watching it. Just got a level with you. I was not watching it. But nice little breakout here in the morning session over 411. Your next idea would be a retest higher low above 411. That's your Brigade bolt, and then you're looking for upside. So that's could be on the radar. There's a fourth and additional idea for you for today's session. That's going to do it for me on this midweek market update. Wednesday night here, we've got 9:30 on the clock Eastern time. If you know the term, drop it down below in the comments section. You guys who have been around the channel for a very long time know exactly what I'm talking about. We'll leave that up to some mystery. If you figure it out, you figure it out. If you know, you know. If you don't know, just look through the comments. I'm sure you'll be able to figure it out. With that said, if you enjoyed the video or learned anything new, let me know down below as well. Give the video a quick, simple thumbs up. Subscribe to the channel. We'll see you back here tomorrow morning at 8 o'clock Eastern time for the pre-market prep. We have the unemployment claims, initial jobless claims, 8:30. And we'll see how the market reacts. We'll set you up with a game plan, and then we'll move along with our days. With that said, have a green trading week, and I will see you in the next one.